Hi, everybody. Good morning. Thank you for those that are just letting us know there's no sound. We were just waiting on the bulk of people joining before we got started. I know we've got a really packed session today, so in the interest of time, I'm going to get going. So, as I said, very good morning to you. Welcome back to the K3 Hub. This is our first session for 2026, and we are just turning five. So, we're delighted to have been here for 5 years. Really glad that you could take out some time on your Friday morning to spend with us. We're all grateful for that. For those who don't know me, my name is Marie Wadeson, and I'm a managing director at the K3 Capital Group, and I also lead the K3 Hub. It's been a really busy start for us here in 2026 at K3 across all of our divisions. We've got a whole range of highlights. I just thought I'd trot through a couple of them. So, in business sales, we retained our most active deal advisor in the UK title for the ninth consecutive year. Restructuring and turnaround division, we secured a number of high profile appointments, which you may have read about in various press titles, including the administration of Leon, the fast food restaurant chain. We've also launched a performance improvement team who have been in very high demand since they launched at the beginning of this year. We've been ranked in Chambers and Legal 500 disputes directories for our forensic accounting expertise and capabilities. And in our tax division, we've seen a rise in and have successfully challenged a series of joint liability notices from HMRC on behalf of clients that you've very kindly referred to us. On to today's session, so a few pieces of housekeeping from me before we get going. So you will have seen as you join the webinar, we are recording today. A recording of the session will be posted on K3 Hub website next week. Normally we do share slides in the chat, but on this morning we're not going to. One of the sessions we've got slides that we'll dip in and out of to illustrate certain points. The other session we have got some slides. So what we thought we'd do is, rather than send you some slides that might look out of context to begin with, what we'll do is we'll wrap everything up and send them to you by email later on. Q&A function is open as always, so do feel free to ask questions as we go along. If I'm going to be chairing the Q&A today, so if you could just pop them in the Q&A, so I'm only looking in one place rather than the chat, that would be great. I'm going to put your questions to our speakers at the end of each of the sessions today. I know from the team in the background running this today that we have had a lot of questions in already. I know that each of our speakers have got a lot of information to cover for you today. So I think it's invariable that we won't be able to get to all of them. If that turns out to be the case, I will get your questions to the relevant speaker and they'll come back to you separately after today's session. Right, so moving on to today's webinar then, it's a tale of, I guess, two stories today. We've got a market and economic outlook, which is a forward-looking view of the year ahead. That's going to cover key trends, risks and opportunities expected in 2026. Practical guidance for navigating the year ahead, and how major developments from 2025 are likely to shape 2026. We've also got a marketing masterclass for you, which is going to cover is AI recommending your business. And Callum, who is returning to the K3 Hub today, is going to cover how AI search actually works. And he's promised me he's going to remove the jargon. He's going to look at GEO versus SEO, and I'm going to need some translation for that. And we're going to look at why your competitors are being recommended and you're not. So I'd like to move on to introducing our first speakers. So I'm very pleased to be able to welcome Marcus Pilkington from Pareto Financial Planning and Alex Brandreth from Luna Investment Management, two sister firms that recently joined the K3 Capital Group family. Together, they advise private clients and their professional advisors on personal investment strategies, pensions and wealth protection, and provide bespoke portfolio management. Marcus is a chartered financial planner, and Alex is responsible for coordinating the overall investment strategy at Luna. So, to get going, Alex, shall we begin with the global economic picture and some of the recent developments which are shaping investor sentiment?
Yeah, thanks, Marie, and thank you to K3 Hub for inviting me to speak today on my first one. I mean, the joys of the economic picture at the moment is it's changing almost on a daily basis. You look at last year, it's kicked off with DeepSeek in China, the Chinese competitor to OpenAI, and then as we went through last year, with the big news was about tariffs. And that's really what's at play today as well. So as we're looking through this year, tariffs is still going to be at play and going to be used. Maybe not to the same extent as last year and cause the same volatility, but we've already seen it this year already with the green threats from Trump in terms of what can happen, and that really impacts global sentiment. That impacts global supply chains because people don't know what to do in that environment. How can I decide a business decision when suddenly there's an extra 25% tariffs? Now, fortunately for us and other NATO allies, the Trump Greenland tariffs have gone temporarily, maybe, but they have been applied to other countries. So he's been using them on South Korea and Japan, etc., recently as well. So something to be mindful of and something that we expect to continue this year. The other big development, and I'm going to go to a positive and a couple of positives, is monetary and fiscal stimulus. So monetary policy, interest rates. We saw interest rates cut in the UK, the US, Europe last year. And it's important to remember that there's always a delay between interest rates being cut and it being felt. If you just think about the mortgage market, for example, if we're on a 2 or 5 year fix, it's going to take a while for you to roll off those 2 5-year fix until you go on to lower rates. And that's going to be a positive, and that's going to come through this year. So the cuts that we saw last year from the Bank of England, there was about 1% of interest rate cuts. That's going to be felt on the UK economy this year. So that's a positive. That's going to stimulate the economy. If you're looking to fiscal stimulus, there's 2 big things which are coming on stream this year. Let's go back to the US. The US have announced the One Big Beautiful Bill. That's a brilliant phrase from Trump. He needs to have a nice slogan for everything, doesn't he? But essentially, that's tax cuts in the US. What Trump's looking to do is raise revenue for the US government from tariffs, but then looking to stimulate the US economy by cutting taxes to companies and individuals. And that's coming on play this year. So that, again, should provide stimulus to the US economy. And closer to home in Europe, Germany introduced a 500 billion euro stimulus and infrastructure plan last year, which is going to be rolled out this year. So you're seeing fiscal stimulus on both sides of us in Europe and the US. So that should really boost global economic growth. Now, you can't talk about global economic growth and not talk about China. Chinese economy has been pretty robust, and they have diversified away from the US over the last few years. So it's a lot more resilient than it would have been 5-10 years ago should the US have been slapping tariffs on then. So globally, we're actually in quite a positive picture at the moment. Closer to home, let's just talk on the UK and just do maybe a quick UK economic picture. As I said, we've got interest rates coming down. The budget last year was what really impacted sentiment last year. The budget in November wasn't as bad. You could argue it's taxes that are coming later in future years. So there shouldn't really be a major overhang this year on the UK economy. The Bank of England did meet yesterday. They didn't cut interest rates yesterday, but we are expecting interest rates to gradually be cut this year. And that should provide a bit more stimulus as well. They did also mention at the Bank of England yesterday that they expect unemployment to trickle higher. So again, maybe a little bit of bad news coming there, and that's probably a overhang from the budget 18 months or so ago. So that's a quick whistle-stop tour of the UK and globe. Marcus, and now over to you. There's been a lot going on. There's been budgets. There's been tariffs. How have investors responded to that? When you're speaking to clients, what's their sentiment and behaviour like?
Yeah, thanks, Alex, and good morning, everybody. I think at the moment, I think the best way I can describe it is a phrase that's sometimes used in our industry, which is cautiously optimistic. I think, obviously, people still feel a bit battered and bruised over the recent years. We had lockdown that had a big impact on markets. Then we had the Russia and Ukraine war, and everyone on the call today will know interest rates, inflation issues that we had at the time. But actually, things have settled down a little bit more. I was with a client yesterday, a fairly kind of balanced to high risk client, and the portfolio over the past 3 years had averaged about 9% a year. So at least everything's going in the right direction. And obviously, Callum speaking later on AI as well. I think it's these things that obviously come in the press, concerns about AI. Is there going to be an AI bubble? Is there going to be a big correction? But I think overall, people are a little bit more positive. As you mentioned then, Alex, interest rates being cut. So people are getting, a couple of years ago, you could probably get maybe 5.5%, 6% on cash. That's come down to about 4%, and obviously it's going to go down even further. So people are then looking at other ways to obviously generate that return that they're not going to get from cash, and they're probably going to be making very little after inflation in real terms. So it's been a bit more positive. Clients are actively now kind of going back in the market, and we're looking at, sort of different types of assets, different types of portfolios for them. But it is, people are a little bit more hopeful than they were 2 years ago, which is really good overall.
Sorry, I like to go off. There you go. Apologies for that, Marcus.
Oh, it's fine. And I think obviously what I was talking then about interest rates as well is that obviously they weren't cut yesterday. I'm hoping for a massive cut in April because my mortgage is up in March. Sorry, because my mortgage is up in April. My mortgage came out a couple of years ago, but interest rates were right at the very high. So I had a 2-year fixed deal. So I'm hoping that they plummet in March so that my mortgage comes down quite considerably. But I think, hopefully that's a positive for everyone in terms of the mortgage rates coming down. Obviously, investment markets, people are going to get less on cash. So as you'll be well aware, Alex, probably something you can touch on as well is the fact that, we've been looking at things like gilt portfolios as alternatives for clients, especially for those who are 45% taxpayers because of the tax benefits associated with them. And obviously clients then aren't taking a significant amount of risk with those funds, but they're going to be getting a much higher return than they will on cash. And obviously, if you've got quite a significant amount sat in cash, even if it's paying you 3-4%, and you're a taxpayer, you've only got a £500 savings allowance, so you're always going to have a fairly high tax bill on that. So actually, looking at a gilt portfolio is probably quite a good idea, and it's probably best to pass that back to you just to explain a bit more on those, Alex.
Yeah, so for gilts are government bonds. So they're called gilt issued bonds, gilt edged securities. It's the step up level of risk from money in the bank, essentially. You're borrowing, you're lending the government money. And whenever you're lending someone money, you get a return on that. But most of the gilts that have been issued over the last 20 or so years, because we've been in a low interest rate environment, have been issued with very low returns in terms of very low interest that you receive. And because the interest that you receive doesn't change, the price moves in the market. And most of the government bonds that we're looking at the moment are priced anywhere between 90 to 95 p in a pound. And what happens at maturity for these government bonds is they mature at a pound. So in a year's time, in 2 years' time, there's a variety of different government bonds on the market. They're going to go from 90 to 95p up to a pound. And that increase in price from 90 to 95 to a pound is completely capital gains tax free. And so it's a very efficient way of getting in a good return from government bonds. The downside is you have to pay tax on the interest, but as I mentioned, the interest that you're receiving is so low because they were all issued when interest rates were very low. So if you're looking at money in the bank and you're getting 4% and you're a 45% taxpayer, you're going to get down to just over 2%. With a government bond, we've looked at the returns. You can get to a return of and a net tax basis of kind of 3.5% to 4%. So it's been a very successful investment strategy that we've been using at Luna. Now, we didn't talk about gilts for 15 years in my career because interest rates were so low and there was just no returns. And now they're pretty widely held across all portfolios from an investment perspective. Now, as you said, Marcus, I mean, what's the risk with gilts? The risk is that the UK government defaults. I know that we've had our wobbles with mini budgets and things over the last few years, but we don't think the UK government is going to default in the next few years. And that's what we would typically do. We'd buy shorter dated gilts as well. So you're not getting the volatility of buying a 30 or 40 year bond to maturity. And the other thing is gilts are the most liquid investment in the UK market. You can buy them and sell them and you get the money back in a day's time. So they're very liquid. What we can do, and what we have been doing for clients, is that we can hold a specific gilt for a specific tax reason. So we had a lot of people invested in the gilt that just matured at the end of January, and that was to pay for their tax bill at the end of Jan. Equally, we can ladder it so we can buy different gilts with different maturities and then rotate and reinvest as that goes through. So there's a lot of flexibility within what we can do within the gilt market. But you're absolutely right, Marcus. It's a really good investment strategy. And have you got many clients that have benefited from that?
I think, yeah, and I think especially those high rate taxpayers, they're looking for a return that, obviously trying to limit the tax bill. Sometimes if it's shorter term, they can put the money in. Some people use them sometimes short term, for future tax bills as well, because they offer a degree of security. And it's just, a portfolio diversifier as well, which is probably something that we'll come on to. But, and it's just a way of really incorporating something, because we know that interest rates are going to go down. They're obviously not going to get to the, everyone who's got a mortgage wishes that they did get that back down to 10 or 0.1 or whatever they were, but that just isn't going to happen. So they will come not as significantly as we expect. And I think now that a gilt portfolio, through someone like Luna, because you can't necessarily go out and buy a gilt portfolio bespoke to you through a normal, fund or a normal pension provider. It's got to be done through someone like yourselves. And I think for those people who have maybe sold a business and they're sat on a significant amount of cash and they're not quite sure what to do with that money, options an SNI, but obviously again, that's similar in that it's government backed as well, but the interest there is going to be taxable. A gilt portfolio offers a certain degree of tax benefits for those, higher rate taxpayers.
Yeah, and just a few really important points there. It gives people time to think. When you just sold your business, you don't necessarily want to go away and invest or find a new business to invest in straight away. So it just gives you that breathing room to be able to think. And look, maybe we should just touch on our expectation for interest rates. So we're at 3.75 at the moment. They were held yesterday. Our expectation is you get 2 or 3 more interest rate cuts this year, which takes us to 3.25. So in a year's time, you're going to be getting even less on cash, as you touched on there, Marcus. And that's because the inflation's coming down. Inflation was quite sticky last year and was higher. But the Bank of England said yesterday, and there's reasons for it, the changes in the budget with regards to fuel and things like that, inflation is expected to get back to 2%, which is the Bank of England target by April, May time. So then that gives the Bank of England the ability to start cutting rates again. We don't think it's going to be, April, May, June. We think it'll probably be, I'm trying to remember the dates. It's August and November, and it'll probably be May. So you probably see the interest rate cuts in May, August, and November, because that's when they get the quarterly report, the monetary policy report, which they also had yesterday. So again, that should be a positive. Maybe not, I don't know if that's in time for your mortgage deal to expire, Marcus, but we'll see. But that's what we're expecting this year, and 3% should be the new normal. The period that we went from the financial crisis to COVID, where interest rates were basically zero for 15 years, is not a normal environment. There has to be a cost of capital. It's a completely normal thing to do. Otherwise, people take on too much debt and take on too much leverage if it's too cheap to borrow. Fortunately, you haven't seen that. I mean, the companies and individuals are in pretty strong shape. You look at the savings ratio in the UK; it's pretty healthy, which is a positive looking forward as well. So, just bringing that back to a bit of a summary, interest rates coming down, 3% is probably the new normal. If you're in a recession or an economy struggling and they're looking to stimulate, you can see that go back down. Equally, if you go into a period that we saw in 2022 where inflation's high or the economy's really taken off, which we're not foreseeing, then you could see interest rates going back to kind of over 5. That's kind of 1.5 to 5, with 3 being the middle is our expectation at the moment.
So I think from a client's perspective, I think looking at the moment in time is kind of a question we get a lot. Well, is it a good time to invest? What's going to happen to markets? etc., etc. And I think, obviously, our principles are to sit down with the client, and we are looking long-term, clearly. Most clients, maybe 40s, 50s, 60s, they've got a long-term view. We don't allow clients to invest unless they're investing with us for a minimum 5 years, because that's obviously to allow the ride outs for the highs and the lows of markets. Typically, 10, 15 years plus is where people are looking. So what we try and ignore is that short-term volatility, because something will always happen. Stats show that generally once every 5 years there is a market event. Like we had 2008, we had a lockdown. Something like that will always happen, but markets tend to recover quite quickly after that. And I think the focus of the portfolios that we do with you, Alex, and the funds that we select as well, is looking at a diverse. I would talk about the same things, but it's a well-diversified portfolio. And I think that you'll know as well, probably you can touch on it in a minute, but we'll go out and see clients and they read in the press, oh, I've got to buy gold. Everything's got to go in gold, got to go in silver. Or clients ask me, what do you think about Bitcoin? Now, if you look at those in the past week, gold got up to 5,500. It now sits at 4,600. It's plummeted. Silver, 120, $120 an ounce. It's now at 74. I had a client last year who thought when Bitcoin was at about 120 that he wanted to put his pension fund in it. Now, it's not regulated in the UK, so we can't do it. But not long ago, Bitcoin was 120,000. Last week, it was $85,000. Today, it's about 66. Now, people are sometimes, they'll read in the press about the next big thing. And I know that we were talking the other week, Alex, that Luna have had a modest increase in the gold and silver exposure in the portfolio, but it's not from 1 to 20%. It's maybe from 1 to 2%, 1 to 3%. It's a very full exposure. And it's just diversifying the portfolio, giving those different assets. Some of the funds that we use, as we were talking about before, will have, fixed interest, they'll have gilts, there'll be corporate bonds, there'll be lower risk, and there'll be some higher assets. But it's trying to ignore the noise of that short-term volatility and actually looking, many years forward. But maybe that comes on quite nicely for you to talk about those perceived safe haven assets of gold and silver and, how the portfolios are structured.
Yeah, of course. I mean, for full clarity, we've actually done very well out of gold and silver. So we started buying gold last January. And the reason we started buying, I'll maybe talk about the reasons why. And we did take profits last week. So we took profits basically a day or two before the market started to correct. So, and Marcus doesn't know that. So I haven't set him up for that question at all. So there you go. So just why did we start buying gold? One was there's so much geopolitical noise nowadays around the world. And then to us, gold is a safe haven asset. You're looking for protection, you're looking for security, that's where people go. The other big development, though, was when Russia invaded the Ukraine, all treasury assets that Russia held were frozen. And not just treasury assets, they did that in Europe. And I don't know if you've seen the press recently, they're looking at trying to use the Russian assets to loan to the Ukraine. Because they're frozen and they're just sat there. And that really put the spooks between global emerging economies, really. Because what happens if they decide to declare a war and their assets get frozen? That's not me speculating that a war is going to come, but it definitely put the frighteners out there. So China, who is the biggest holder of US treasuries, has started to diversify its reserves. And what they've been doing is they've been gradually selling, or as they mature, their US Treasury bonds, and they've been reinvesting the proceeds in gold. So you've got a natural buyer, and it's not a small natural buyer. It's the biggest, one of the biggest economies in the world buying an asset class. So that's a structurally positive on a demand side. Donald Trump and interest rates. Interest rates coming down. Because you don't get interest on gold, and as interest rates come down, it makes gold more attractive. And I haven't touched on it yet, but clearly there's a lot of volatility going around who's going to be the next Fed chairman, and the pressure from Donald Trump to get interest rates down to stimulate the economy in the last few years of his presidency. So that's another dynamic which has been supportive of the price of gold. And then as a knock-on effect, silver is another precious metal. It's filtered down there as well. And then I suppose that's the demand side, but the other important thing to remember is the supply side. Now, how long does it take to get a gold mine or a silver mine on stream? And not more so than that, as it's been from an environmental perspective, it's not been viable for the government to sanction these projects either. You look at the problem that we've had trying to get any fracking or something in the UK. It's just socially unacceptable nowadays to get a mine on stream. So there's not really a lot of new supply coming on stream at a time when demand's coming through the roof. The point on China as well, I'll just come back to that in terms of Chinese buying. That's a price insensitive buyer. They need to diversify their resources, their reserves, so they're just going to carry on buying gold. And then, Marcus, back to what you were saying before, then you get the speculation, then you get the investment. You see investors see it going up, so then they jump on the bandwagon. And then it's exactly what happened with gold. So we were buying gold in January last year. We sold it last week. And we'd made, just trying to get the numbers right, this is in sterling terms because we lost a bit on the dollar because the dollar's depreciated. And maybe just come back to that actually. I suppose the other thing with Donald Trump and his plans is that the US is running a massive fiscal deficit at the moment. And the one big beautiful bill and tax cuts is a bit like Liz Truss to me. And maybe the US can get away with it because of the reserve currency of the world, but they're just putting more and more debt into their economy. And people are getting nervous about that and then thinking, well, should I be holding so much treasuries? Because of the risk that they're potentially, I don't think they will default, but the risk that they do in the future is going up. So you have seen global bond yields increase because of the amount of debt that central banks have taken on global government side. Now, why did we take profits last week? Just as you said, Marcus, we'd made 60% in gold within a year, which was a fantastic return. We actually bought silver mining shares, only for high-risk clients, though, because they were a higher-risk product. We started buying them in October. We'd made 65% in 4 months. So we just took all of the profit out last week. And that's the beauty of what we can do at Luna. We're a discretionary manager. So we can see things and trends and we can look to take advantage of these short-term moves. Now, that's a short-term decision. Longer term, these dynamics aren't going away. Interest rates are coming down. Global governments will keep wanting to diversify their reserves. So they're an important part of a portfolio. But I think the most important point you made earlier, Marcus, is it's about being diversified. Though we've got 2 or 3% in these portfolios. We're invested across different asset classes to get that diversification. And again, just bringing it back to an investment perspective, Marcus, I mean, some of the conversations that we've had over the last few years has been about US technology, AI, and how well these share prices have done. Now, the stock market in the US has absolutely flown, and you've seen Nvidia become the biggest global company over the last 3 years from being a significantly smaller one, and that's driven share prices higher and people's wealth higher. And at the beginning of last year, everyone was saying to me, "Oh, AI is going to keep delivering, and they're going to keep delivering good share prices." But what happened last year was the S&P 500 did 10%. The FTSE All Share, so investing in the UK last year, you got 24%. Now, just to put that number in context, a normal year for the FTSE is about 7 to 8%. That's what you should expect from equity markets over the long term. So for the FTSE All Share to deliver 24% in the year is absolutely knockout. And that's led to a lot of questions that we're getting from clients is, can this continue? I don't know if you're getting the same type of questions, Marcus, with markets being at all-time high.
Yeah, we are. And I think, as I say, that's why clients are, that phrase, cautiously optimistic, because they're hopeful. I think because the FTSE, tipped over 10,000 for the first time. And then I think a lot of clients just expected it to correct and come back down and be under, And I think it's just that feeling about what's happened in the past 4 to 5 years. And I think they're just a bit. But as I say, and, not long ago, the FTSE was years ago, it was at 7,000-8,000, and then it's come all the way back up, and there's no reason for it to carry on going up and up and up. So, it is a good, hopefully, a good longer term picture, but it's just that necessity just to get the portfolio structure mapped to your risk and just to have it well diversified, and just try and, as I say, like you said, sort of leave the experts to get that little bit of exposure into these areas where you can do, but don't try and put the whole of your pension fund or something into gold or Bitcoin, or because it could be short term. Yeah. Before short term, it could be brilliant, but then you check on it a week later and it's absolutely crashed. So it's just about that diversification, really.
Yeah, I think that's a really good point, Marcus. And people say to me, should markets be at all-time highs? Is that a worrying sign? And what I always answer to that is the market should really every year hit all-time highs, because companies' earnings should grow. That means that those businesses should be more profitable. So the FTSE level should go up. And there's also just some maths behind it as well. So we were talking about this on the team the other day. So for the FTSE to go from 7,000 to 10,000, that's almost a 50% increase. But if you're thinking about where the FTSE needs to go for a 50% increase now, that would take it to 15,000. So you've gone from a 3,000 jump on the FTSE now to a 5,000 jump on the FTSE just from the maths behind it. So you should expect markets to go higher. And I'm going to actually share a slide. We haven't shared any slides so far, but I think this is my favourite slide, and that's why people call me a bit sad, because I've got a favourite slide. Let's just do it from this slide, see if that works. So back to what Marcus said, corrections are very common. So this looks at the FTSE All Share, and it goes all the way back to 1986. So 40 years of data here. What this chart shows is the red dot is the worst possible point of the market during the year. And I suppose the point being that you always have a red dot. Markets always fall in any particular year, and the average fall in the market is around 15%, and the median is 12%, as you can see at the top there. What the grey bars represent, though, is, well, what did the market actually do for the whole year? And you can see there that 3/4 of the time, you've got a positive grey bar. So markets tend to be positive most of the time, and some of the returns there are pretty significant. Last year was probably the perfect example of it. You had that drawdown in April when Trump did his inauguration speech. Markets were very weak. They then recovered and ended the year very strongly. So, volatility is very normal. You shouldn't be scared of it. I mean, we had a lot of clients that were saying to us in April, Alex, this looks dreadful. What should we do? Should we be disinvesting with, Donald Trump's in the White House? And we said, no, just keep calm. The best thing to do is ride out this period of volatility. We don't know what will happen. We don't know when it will happen, but markets recover. And it's almost at that point of maximum uncertainty is when you deliver the best returns. And Marcus is probably sick of me saying this, but the low on the market in COVID was the 25th of March. And that was also the day that Boris Johnson said that we were going into a national lockdown. Now, who would have thought that the low on the stock market would also be the day when it looked like it was the most pessimistic? But that's exactly what happened. And then we know how things played out through 2020. We went lockdown, and then the markets went through the roof in November when the first vaccine was announced. So, and then people could start looking forward to the fact that economies are going to reopen, companies can get back to normal, etc. So, yeah, always take a long-term approach. You touched on it there, Marcus. We've had wars, we've had pandemics, we've had Donald Trump, we've had inflation, we've had almost everything thrown at us the last 5-6 years, and yet markets are at all-time high. Marcus, one of the big things that's happening locally, and I kind of touched on it right at the beginning, is the budget. Yeah. What are clients saying? What are companies saying? What's happening there? There's a lot of volatility being caused by the Labour government at the moment.
Yeah, I think obviously, recent years there's always been a lot of panic around the budget, and cards very close to the chest with regards to what's going to be going on. But we've had a bit of certainty from the last budget at the end of last year, and I think it's, for a lot of people out there, business owners in particular, I think there's a general lack of awareness about what's coming. And one of the big changes is actually in a few months' time, from April 2026. So The big one has always been to do with business property relief, business assets. They changed the allowance last year, and they said, right, and essentially anything over £1 million, if you own a business for £10 million, anything over £1 million, even if you haven't sold a business, there's an effective tax charge, IC charge on above the million of 20%. They increased that to £2.5 million. So that, I think that was announced just before Christmas. So, and if there's husband and wife or partners in the business, then they've got that is transferable, for example, between a husband and wife. So that in theory they've got £5 million, but anything above that, even if they don't sell the business, there's a 20% tax charge on it. And I did a podcast this week with one of the managing directors from one of the corporate finance companies within the K3 group. And he said he was sat at a dinner last week next to a guy who was fully aware of all the changes to agricultural property relief and how that was affecting farmers. And the guy said to the client, to the individual with the business, "Oh, so what you think about the impact on your business?" And he said, "What impact on my business?" And he had absolutely no idea that the changes were coming. So we've got a lot of business owners now who suddenly, from April, significant sized business, have a considerable potential inheritance tax liability that they never had before. So we're talking to clients about the ways that we can plan, look at that. So there's a lot of work on that at the moment. And then obviously, probably that affects a lot of people on this call, maybe not short term, but is the inclusion of your pension assets also in your estate from April 2027. And a lot of people out there, that's an impact on business owners who are extracting cash out. So they've probably got a fairly sizable pension pot and they've got a business, and then suddenly within the next 15 months, all that's suddenly in their estate. But just a lot of our clients who've saved over the years, pensions were always outside of your estate for inheritance tax. Suddenly, in 15 months' time, they're included. So we're looking at that for clients at the moment. Maybe not a knee-jerk reaction because, they changed the business property relief allowance from 1 up to 2.5. Probably most people have got the fingers crossed that they do something different with regards to the pensions. I'm not sure they will. But what we've seen is maybe clients starting to draw on the pensions now where they never did before because it was outside of their estate. And they're either spending that money on themselves, they're using basic exemptions, they're giving money away out of income allowance, so they're doing that as well. Or they're using it, for example, to fund a life insurance policy to meet some of that liability. So, I could probably talk for an hour in what's going on, but that's the key areas that we're looking at: business owners, pensions, and just, we're doing a lot of work at the moment to try and increase that awareness with them at the moment.
Okay. I think it's just maybe useful as well that we work with David Smith. He's an independent consultant for Lunard. If you don't know David Smith, he's the chief economics editor at the Sunday Times, writes excellent articles, and he supports us. And I was speaking to him 2 weeks ago, actually, and we were just asking, what do you think is going to happen this year from a political perspective? And he was quite damning on both the Chancellor and the Prime Minister, actually, mostly the Chancellor, in terms of, don't know if you can remember back to the budget, but there was all that hoo-ha about the increased revenue coming from wages and tax that had been generated that hadn't been disclosed. But then there was information that had been leaked about, that they were going to struggle to meet the fiscal rules. So, but it's going to be a big year for Labour. You've got the May local elections coming up. They are trying to defer some of those elections. But let's wait and see. There's talk again this morning of a leadership contest, and he was saying he wouldn't be surprised if you see something in the next year or so where potentially new Chancellor and Prime Minister in play. But if they're going to go together. So we'll see. That's something definitely to be keeping an eye on this year as well. So just on that, there's, in terms of looking forward, we've mentioned the May elections there. In the US, you've got the midterm elections, so that's in November time, and that's quite key, and that's impacted some of our investment decisions actually this year. What do you tend to see from midterm elections is that you lose either the Senate or the House. And that means that it should hopefully handcuff Donald Trump a little bit in what he can do. I mean, I'm sure he'll try and find ways around it with his executive orders, etc. But again, that could be a positive for the US as we move into this year. And that impacts particular sectors. So healthcare is a good example of a sector that's politically driven in the US because of the cost of drugs, etc. We've already seen that come through. So that's just, it impacts investor decision as well. So something that we're thinking about. Marcus, we've talked, I think we've been quite positive this morning, haven't we? I tried to be quite positive in terms of global economic growth, but what about, are you seeing any bad news out there in terms of expectations at all?
No. I think the only bad news it's more to do with planning opportunities, isn't it? It's the budget. It's causing people headaches. There was as we get the past few years, there was always that panic that, tax-free cash is going down, tax-free cash is going to be reduced. People panic. They take loads of money out of the pension schemes, which probably with the changing rules isn't always a bad thing, but as such, they take it out, they put it in cash, or they do something else with it. And I think it's just been that uncertainty with the budget, and as I say, fixing of things like the nil rate ban for inheritance taxes fixed till 2030. Tax bans have been frozen, and it's just dragging. I think this year with the increase in the state pension, if you're on a full state pension, that just slightly tips you over your personal allowance as well. So it's just more and more people are just being pulled into paying tax. But I think generally speaking, people have been a little bit more positive. As I said before, we've had a better 2 or 3 years than we've seen previously. And as I say, it's more the governmental side, it's more the legislative changes that are coming in the next kind of 18 months, which is, that's kind of keeping us busy at the moment.
Yeah, okay. Brilliant. Maria, I think we're end of our formal bit now. Is it okay if we've got any questions? I've seen it flashing up, but it's been distracting me a little bit, but I've been trying to keep focused.
Yeah, thank you very much to you both for that. That was an absolutely fascinating canter through the markets. Really insightful. Thank you. As you say, we have got a lot of questions coming in, and I'm very conscious of time and that Callum is waiting in the wings. So I think I'm just going to dip into one of the questions that summarizes a key theme that quite a lot of our questions are pointing towards. So, does the UK's poorer performance than other G7 nations place us in a better or worse position for inward investment? And in particular, can we expect PE activity to be higher in 2026 than in recent years?
Well, that's a good question. There's quite a few parts to that as well, so let me break it down. I think I've got a slide on the UK economy, so let me just get that up. 2 secs. Right, so I think this is the first thing I'll touch on. So this is not got the whole G7 on, but you've got UK, Japan, US, and different countries in Europe. And this chart looks at economic growth for 2025 and 2026. So you can see there that the UK grew last year by about just under 1.5%, and this year it's going to be about 1%. US is growing about 2%. There was actually some really strong figures out from the US for the final quarter that came out yesterday. So the joys of putting these slides together, they're out of date pretty quickly. But what I'd highlight with the UK, and I think maybe there's a lot of negativity, maybe just press news as well about the UK economy, but the UK is growing similar to Japan and different European countries. Germany was very close to a recession last year and narrowly avoided it. It would have been the 3rd year that Germany was in recession on a bounce. You'd look at France. France have been trying to put through legislation and things through Parliament. They're trying to even get rid of bank holidays because the French finances are struggling so much. And that's because UK, Europe, we've all got the same issues. We've all got quite high levels of debt, and we're trying to sort out our finances. And when you're doing that, you just tend to grow a little bit slower. So I wouldn't say that the UK is in a really bad place. It's just growing a little bit below average. The UK should grow by 2%, and we're growing by about 1.5 to 1 at the moment. The second part of that question was about inward investment in the UK. I mean, you're seeing it all the time. I look at public markets mainly, but we're expecting an increase again this year. You've already seen potentially one of the biggest mining deals announced this year. Glencore been approached as part of a merger. Now, but you're also seeing, I see it every day. Company valuations are too cheap in the UK, and they have been for a long period of time. Maybe that's still a bit of a Brexit overhang. I don't know. But we feel valuations for UK businesses are too cheap versus competitors, whether they be in Europe and the US. And there's only one way that can be solved, and that's if more acquisitions and deals are done. So as the cost of finance comes down, as we touched on, interest rates coming down, within there could be a positive environment for more takeover activity within the UK.
Great, thank you. I think we're out of time for this session.
Oh,
it's been absolutely
okay.
fascinating, and I know that you are due to come back. For anybody that's interested, you're due to come back on with us in April and in July as well. So we'll really look forward to that. I have got quite a few questions for you. I'm going to send them over to you after this session, and then you'll go back separately to those that have asked them. Right, so moving on to our next session, then I can see that there's a whole bunch of people have just joined, and our number of delegates has leapt. So I'm very pleased to be able to welcome back Callum McRae, who joins us from JE Consulting, part of the K3 Capital Group and an award-winning marketing agency. Callum is an experienced marketing leader with over 16 years of B2B marketing experience, who has a strong background in driving growth through demand generation and strategic campaigns. Callum, thank you very much for coming back. I'm going to hand over to you.
Thank you very much. Thank you for the kind introduction. I'm going to share my screen, and hopefully that comes through fine. Okay, so yeah, delighted to be here, and thank you for giving up your time on a Friday morning. I'm here to talk about AI search and how this is rapidly increasing. Some of you might not even know that this is happening. So I'm going to dive into a bit around SEO and GEO. I promise I'll explain what they are and what the acronyms stand for. Dive into some stats that you can't ignore. What people are actually searching for now on AI and specifically ChatGPT, and how do you as a business actually start to appear in ChatGPT and other AI engines. And of course, I'll explain why this is even important to begin with. So appreciate Marie gave me a lovely introduction. So yeah, a bit about me. So marketing director at JE Consulting. So we're a full service marketing agency. My background pre-agency was leading the marketing for Irish Software Group, for those of you who know it. So leading accountancy, payroll and HR provider across the globe. So that's a little bit about me. Anyway, we're going to dive into what's actually changing in terms of the search landscape. So if we think about how we search, and SEO, which is search engine optimization for those who don't know, it's really all about being in the right place at the right time. So you can see the example on the screen here. We're searching with very specific intent. So if you think about putting yourself in the consumer's shoes, you can see the example on screen here for accountants in Sutton Coldfield. For the last 15 probably years, it's always been about SEO, and it's always been about ranking number one on Google, and that's been super important for businesses. It's that race to the top, and as I say, that's always been about the right place, the right time. You can see here as well, highlighted in the example, that that's always been about keywords. So again, making sure that you're seeding the right keywords in your copy. So you can see here, for example, where accountants in Sutton Coldfield is highlighted in bold underneath the actual website URL. And that again has been, as long as I've been in marketing, really the way to do it. And that's really where it becomes quite an exciting conversation, because things are changing. So over the past year, there's been a lot of talk around GEO and also AEO. So they're both the same. There's just different acronyms. So again, traditional SEO is what I've just showed you on the previous slide. So you're typing into Google or other search engines with very specific intent, and what you'll then get is a list of websites with different meta descriptions. And as I said, that is based usually on keywords. It's usually based on backlinks, your domain authority as a business. And also the user is really deciding which link to click on. So again, it's always been that race to be number one on Google. Now with GEO, which is generative engine optimization, this is really where people are starting to search through tools like ChatGPT, through Gemini, Claude, even asking Copilot. And what we're starting to see is a shift in behavior. So on the last slide, you can see where I typed in accountants in Sutton Coldfield, and it'll give me that list. If you think about, and if you're using ChatGPT or AI engines yourself, it's become a lot more conversational with AI. So an example that you can see on the right hand side is that somebody might ask ChatGPT which accountancy firm in Manchester is most trusted for tax advice, or which legal firm in London is most reputable for family disputes. Okay, so we're having a conversation with AI, and as a result, that's changing the output. And that's because AI will then give you a direct recommendation. Now, if you've done this yourself, you'll know that it'll typically give you a list, probably of 3 to 5 recommendations. And that will then, in this case, give you, details about the business. It'll give you the reason why it's displaying that particular business. And it'll also dive into some, other important factors such as reviews, awards, etc., which I'll touch on in a few slides' time. But geo is very different to SEO, and there's several factors which basically mean that you'll be ranked in AI. So for those of you who've historically think, oh, I'm ranking number one on Google, we're winning the race in that sense. That's very much changed, and I'll touch on why that's changed now. So again, for those of you who will search on the internet, you'll probably notice now if you go onto Google as an example, if you type something into Google, at the top you'll get what's called an AI overview. Now, 60% of searches are actually now complete without users clicking through to other websites. So back to a few slides ago where I showed you, accountants in Sutton Coldfield, and it then gives you a list. Well, actually now what's happening is that most people are getting the answer from the AI overview. So they're actually not clicking on your website link. So again, this is where it's becoming less important in that respect, and it's not just all about SEO because AI is giving you the answer. And then in most cases what will happen is that the people are doing research, so they'll ask Google the question or they'll type in the search term. Google will give them the answer, and it might recommend, again going back to the recommendations that it gives, might recommend 1 or 2 brands in that AI overview. And then what you'll find later on is that people are actually going to come back as a direct visitor to your website or search specifically for your brand on Google as opposed to searching for a specific term. So again, why this is important, AI overviews now appear in just under 50% of all Google search results, and that figure is growing by the day. So again, whatever you're typing on Google, as I say, you'll probably usually see that AI overview, and that's increasing more and more. Now, as a result, what we're seeing as a trend from a marketing perspective is that organic web traffic is reducing by 15 to 25%. It's probably teetering more towards the 25%, to be honest. But as a marketer, it's been quite fascinating to dive into this because we've seen this increase in what we call zero-click traffic. So again, AI overviews giving you, let's say, a brand or two as a recommendation. So whilst you might be getting less organic traffic through, and quite often, when we're working with clients, that can obviously raise alarm bells, right? Because you're getting less and less traffic to your website. However, the thing to keep an eye on is the number of conversions coming through from your website, because there's an interesting shift now where we're seeing less organic traffic, but because the AI overview is giving a recommendation, they're coming back to your website with stronger intent and therefore more likely to convert. So again, just watch out for that correlation, because whilst your organic web traffic might be decreasing, your conversions might actually be increasing. Now, why is this actually important? So there's some fantastic research out there from Adobe that was done towards the end of the summer last year. And it showed that of ChatGPT's users, 77% use it as a search engine. So again, why this is becoming increasingly important is because Google's been the go-to solution for years, right? To go and search for information. Well, actually, 70% of ChatGPT users are actually using it for that reason. And 24% of those people surveyed will go to ChatGPT first. And interestingly, Generation Z are the most likely to do so. So just under a third of Gen Z are going to ChatGPT instead of Google. Now, where that becomes really interesting as well is Gen Z, if you think of them as a demographic and how they're using different tools. So on average, Gen Z, 40% of them will use TikTok as a search engine, and then 28% are using ChatGPT as a search engine. So that's 68% of that demographic that are not using Google as their go-to search engine, to put that into perspective. So while Google, Bing, and the kind of classic traditional search engine has been that go-to for businesses, it's forcing a lot of businesses to really rethink their strategy, because the younger generation that are coming up and the younger businesses that are starting up aren't actually going to those traditional search engines as a first look. And again, within that same research, it did reveal that 36% are discovering new products and brands through ChatGPT. And again, Gen Z leading the way there with 47%, and millennials at 37% there. So again, they're using it to find brands, they're using it to buy products. So again, this isn't, and this is just from the summer last year. So these stats are probably going to have increased when the research is refreshed later this year. So again, this is stuff that you can't really ignore as a business. Now, what people are actually searching for on ChatGPT, again, if you think of yourself, I use ChatGPT. And I'll go on and I'll use it for everyday questions. I might use it for some of the, the blank canvas thinking. Again, you've got that product research that you can see there, 34%. You've got, again, from a careers perspective, a lot of people are using ChatGPT to actually research about brands and culture. So again, incredibly important if you're on a recruitment drive, to think again how you can actually start appearing in AI search engines. Financial or investing advice, 21%. So again, these are huge stats that are only ever going to increase. If you think of ChatGPT, it's actually not been around that long, and it's only ever going to increase as we've seen in the last few years. Now, again, I spoke earlier around monitoring how AI overviews actually impact the number of click-throughs. So I spoke around there how website traffic has declined. So, some research there showed that 39% of marketers say that the website traffic has declined. And, I'll touch on obviously shortly one of the most common questions I get asked around SEO, geo. Does that mean that we need to stop all SEO? Does it mean that ranking number one is less meaningful? And I think there's an argument for both. It's very much thinking about your demographic, and the likelihood is that most people on this webinar today will have multiple demographics. So it's not just about trying to show up in one area. It's about trying to think of all the different plates that you can start spinning and showing up where your audience is. So I've probably told you there what the problem is, but what can you actually do about it? So there's a few key areas where you can actually start to make a difference and start showing up in ChatGPT. Now, regular content is incredibly important. It's important for SEO anyway, because Google likes it if you're posting regular content, but it's really important for geo. And the reason behind that now, and what you'll probably start to see if you read content yourselves, is if we take a blog article as an example, okay, you might have a 300 to 400 word blog. Now, ChatGPT and other AI engines really like it if you're answering specific questions clearly. So a top tip from me would be that if you have blog content, at the bottom now, what you'll typically find if you land on a business's website is you'll start to see more and more FAQ content. So FAQs incredibly important when it comes to appearing in AI search engines. So if you think about a blog, think about the top three questions that you might be asked, that if somebody's going to ring your business in relation to that specific topic, what are the top 3 or 5 questions that you're going to get asked? And again, just including those questions at the bottom of the blog really helps in terms of visibility in ChatGPT. Because if you think again, when somebody is going to ChatGPT and they're asking a question, coming back to those common FAQs, if Google or other search engines can link and find, oh, okay, A, B, C, and Co has written about this and they've answered this question, you're going to be more likely to start appearing in some of those AI search engines. Another really important aspect, I mean, I preach about advocacy and reviews a lot, but again, this is becoming really, really important when it comes to AI search engines, is reviews. So again, thinking of Google reviews, Trustpilot, FIFO, there's so many different review platforms out there. Obviously, Google reviews and Trustpilot are probably the two ones in the main. So think of yourself now as your business, or even just do a quick Google and see what your Google reviews are actually showing up. And again, when we do this with clients, it's actually quite telling because they're quite shocked maybe at either their Google ranking, the Google star ranking, but also the frequency of those reviews. When the reality is that you've probably got a lot of low hanging fruit in terms of Google reviews on your doorstep that you can go and ask for. It's just a case of actually asking for them and thinking about within your business, whether it's after completed work or what those milestones are. But when it's appropriate to actually ask for those reviews, obviously what you don't want to do is open the door to a lot of 1-star reviews, right? But again, if you think back to what I was talking around earlier of how we're having a conversation with AI, so typically what we'll say now is, you know, what's the most recommended restaurant, Indian restaurant in Birmingham? Just using that as an example, because we're asking the specific search terms for most recommended, most trusted. We're not just going into Google and saying Indian restaurants in Birmingham, right? We're searching for very specific intent and we're asking it, who's the most recommended, who's the most trusted. So what the AI engine is doing then is automatically going in and pulling out reviews and other trust metrics, other social proof points to say, these are the businesses that I recommend. So if you've got a really poor Google review rating or really poor Trustpilot rating, or even if you've got, let's say, a 5-star Google rating, but your last review was a year ago, the reality is you're probably not going to be showing up. So again, reviews incredibly important, and that social advocacy is going to drive much more visibility for you in AI search engines. Again, another thing that's really important is award wins, but not also award wins. I always kind of preach that if you're shortlisted for an award, you can get just the same amount of PR for being shortlisted and being a finalist as you can for winning. So again, making sure that if you're shortlisted, if you're a finalist, if you're winners, again, I speak from personal experience recently of a prospect who revealed that they were winners of a recent award. Nothing on their website, nothing on their social media about that. And again, you're just not going to be found because, again, if you're searching for most recommended, most trusted, award wins is that's just increasing your armor in that sense. It's increasing your likelihood to appear. So that digital PR engine is really, really important. So again, think about those three things. Think about your business now. And if you're frequently posting content, does it include FAQs? Look at your Google review rating, look at your Trustpilot review rating. When was the last time you had a Trustpilot or Google review? And are they frequent enough? Now, again, AI is changing by the day. These are large language models. So you getting a great Google review today, fine, but the frequency is really, really important. This isn't just a case of littering loads of Google reviews in a month and then doing nothing about it. The frequency and quality is super, super important. And then think about, in the past 12 months, those award wins, those awards, shortlisting, finalists, etc. Are they promoted enough on your website? Are you actually making use of that from a digital PR perspective? So Why should you care ultimately? Well, there's again some great research from Gartner which has showed that there's already been a 25% drop in traditional search that was predicted to happen by 2026, which is obviously now. And that's going to increase another 25% by 2028. So again, back to the stats that we went into earlier in terms of how we're seeing this increase in zero click traffic and traditional search, it's already having an impact. So this isn't a case of just, oh, thanks very much for this insight, let's do nothing about it. This is a big wake up call for a lot of businesses. And again, 50%, if not more, of search traffic is expected to move to AI platforms. And the biggest statistic, which when I was actually prepping for this presentation, so the bottom figure has actually jumped quite drastically. So I did this presentation a couple of months ago, and the figure was 650 million at the time. And at the end of 2025, that figure has now jumped that ChatGPT has more than 800 million weekly active users. And again, if you think of the slide from just before, if I just pull back to it, you've got 77% using it as a search engine. So 800 million, 77% using it as a search engine, just to put that into perspective for you. Um, so this is something that you can't ignore, right? This is only ever increasing. As I said, that figure's jumped to 150 million in a couple of months. This is showing no signs of slowing down. And I think another reason why you should care, you may have seen recently in the press as well, there's been reports of it starting off in the US as a rollout, but there's actually advertising coming to ChatGPT. So if you think again how there's Google ads and there's paid adverts, ChatGPT is actually latching on to that. They're starting with the US as a soft rollout. Obviously, that's going to roll out across the world, but there'll be ads within ChatGPT. So this is absolutely the direction of travel, not only for consumers, but for businesses to get in front of the relevant audience as well. So again, the most common question I get asked is geo replacing SEO? The simple answer is no. Again, geo is built on good practice SEO. So this isn't a case of saying stop all SEO by any means. It's quite the opposite. As I said, it's built on the good foundation of SEO, geo. I think around again back to the point of where your audience is showing up. So I use an example of when I work software side, we did this huge piece where we wanted to do a bit of an audit to see where we were actually showing up for three core areas. And it was quite telling for us because I think we had this view of we're showing up for these three areas, so it's absolutely fine. And it was quite the opposite. And we looked at this both from an SEO and a geo perspective quite early on at the time. So I think the question that I would say to you is, what are your main focus areas? And also, what are your three main core focus areas for your business, but also what do you want those three core areas to be maybe in 12 months? So there could be a particular core focus area for you as a business that you're really wanting to push a particular service line or a particular area of specialism. And I think that's the place to start from an audit perspective is to look at where you're actually appearing and where you're actually ranking, because the results can be incredibly telling, but it also gives you a starting point. So when we did this software side, and as I say, we were quite surprised for certain areas that we weren't showing up. We then focused on that for a quarter. We managed to get ourselves on page one of Google and actually to start appearing in certain large language model systems at the time. And that's the thing is this isn't just an overnight fix. This isn't a click of the fingers, particularly from a geo perspective. And when we're working with clients to improve their AI visibility, you've got to allow minimum 3 to 4 months for you to start seeing results. And that's because it's changing every day. So you've got businesses who are already on the front foot here, who are already appearing number one, ranking on ChatGPT, and they don't want to move from there. So it's all about improving that visibility, and that obviously takes time as well. But this isn't a case of saying that geo is disappearing. SEO is disappearing. It's definitely quite the opposite, and it's more that it builds on that solid foundation. Um, I'm mindful that there'll probably be quite a few questions, which I am more than happy to dive into today. I think my biggest tip is that if you're not doing anything about appearing in AI search engines, is to start thinking about how you can. We, as I've said, a full service agency, so we are here to help. We've been doing this for a very long time, nearly 30 years, and we help professional service firms. We work with software vendors and SMEs, so this isn't our kind of first rodeo. We are used to this, so more than happy to have a conversation about how we could potentially help, even if it's just establishing that first visibility. One of the ways which we can do that, if you are interested, and the slides will be shared, we are offering a free AI audit. So this is really around how are you actually appearing within those AI search engines, if you're appearing at all, but also to identify the competitors that are appearing. And I think that's the interesting piece whenever we've been working with clients over the past year on the AI search piece, when we actually go to them with the results. I think it's the results that they've actually found more interesting because it's quite often maybe not the common competitors that you would think, and that's because you've got probably some of the more local established businesses who are maybe doing it a bit better. So the results can be quite telling. So if you are interested, there is a QR code there that you can scan and get a link to your free AI audit. I hope that's been useful, and appreciate the slides will be shared. So and please feel free to connect with me on LinkedIn if you do have any questions. I think contact details will be shared, but yeah, equally, if you do have any questions, I think we've got enough time to allow for questions for the presentation. So I will stop sharing my screen.
Thank you very much, Callum. That was super interesting. As you rightly suggested, we have had some questions in, so I'm just going to dive straight into those. And I'm just going to read them as they've come in, actually. So,
Mhm.
one of our delegates has asked, you mentioned trust signals earlier. What's
Mhm.
one quick win businesses can action this week?
Get more reviews today, whether it's Google, Trustpilot, or sector-specific directories. Reviews are one of the strongest trust signals that AI tools are picking up right now. So, as I say, if you've just completed a piece of work and the client's happy, thinking about those key milestones, ask them for a review. You know, I think quite often businesses have these reviews and stories at their fingertips. They're just not doing the best job of actually getting them. AI is not psychic. It's scanning what's out there. Give it something worth finding is my advice. So I think reviews absolutely important.
And if our delegates had a limited amount of time, they've got a review, or that they've got somebody willing to give a review, what's if they had to pick one platform, which
Hmm.
one would you point them to?
It's a really great question. I think Google reviews is typically the most common just from a search perspective, because again, I think if you put yourself in the shoes of a consumer, if I go on to, I don't know, I used an example before, right, of a restaurant. So I was away before Christmas in New York, and the first thing that I did was most recommended restaurants in New York, and I'm going on and I'm looking at the star ratings, and typically I think naturally Google's the one that you do probably go to, but as I say, Trustpilot is equally more and more common. So there's so many different review platforms out there, but as I say, Google and Trustpilot are the two that I would probably be focused on.
Okay, so let me just drill into Trustpilot for a second. You've obviously got I guess, a free version. Then
Yes.
you've got a paid for. Any
Yeah.
views on whether delegates should actively seek to pay for an account on there, or
Yeah,
if
I
it's the
would.
free version, will that suffice?
It's a really great question. I would say it depends on where you're at with your Trustpilot journey. I don't like to use the word journey, but if you're just starting to proactively use Trustpilot, the free version's great for building it up. Trustpilot are quite savvy in the way that they've commercialized their model and how businesses can actually, have the Trustpilot widgets on their website, for example. So
Yep.
they will get to, I always think there's a tipping point. And I think if you've got hundreds of reviews, for example, on Trustpilot, it probably does start to become a bit of a no-brainer in terms of the paid version, just because of the functionality that comes with it. but there is a cost attached to it. So it's being prepared for that because whilst it's a couple of £100 a month, that obviously adds up, and it goes beyond that as well in terms of paid functionality. There's different tiers. So I would say if you just start in, the free version's fine, but if you obviously want to utilize more of the functionality to get it plugged into your website, and to start actively promoting it. And they have, again, great kind of social plugin tools as well. The paid version, is worth considering. But I think if you're just starting, the free version's fine.
Great, thank you. Right, let me just move on to the next question then. So, biggest prediction for how search will look this time next year?
Yeah, it's a really interesting one. I think for me, what we're actually going to see the rise of, if I'm kind of using my crystal ball, is probably what I would describe as the rise of searchless discovery. So what I mean by that is I don't just think that AI is going to answer questions. I think it's going to anticipate them. So if I kind of put that into perspective, so if you think about how we use AI day to day now, right, it's probably embedded in a lot of what we do day to day in our daily workflow. But I think where it's going to go in terms of your browser, your email, your device, I think it's going to start to search in terms of that landscape. It will start to offer suggestions before somebody even searches, is where I think it's going to get to. I mean, a great example of that, right, is there's this kind of constant debate about Alexa listening to you, right, in the house and things like that, and how sometimes you'll say something out loud and then you'll either go on your phone and you see an advert relating to the same topic. So I do think we'll start to see this shift in terms of searchless discovery. I think, yeah, I think again, it comes back to we're only, I think, very early on in terms of AI and its discovery. Like, I think it's grown massively. It's only ever going to increase in terms of how it affects our daily life. So I think the searchless discovery is going to be one to watch out for.
Right, very good. That's slightly terrifying with the A word. I've got one sat quite close to me, so I'm
Yeah,
going to say
yeah.
that. um, right, next question then. So you said visibility and preference aren't the same thing anymore. What does that mean for brands that have always relied on being top of Google?
Yeah, I think quite simply put, it means that the game's changed. So you could be number one on Google and still not mentioned in AI search engines. That is the reality that I think a lot of businesses are really struggling to grasp at the moment. But that is the reality. You could be number one on Google, but you're not even mentioned on AI search. So again, where that's really important is you search something on Google, you get the AI overview. Fair enough, you're number one below it, but people aren't clicking. So I think where that visibility piece is super important is that traditional search engine optimization got you seen as a business, but being seen doesn't mean being chosen now. So AI tools, again, recommend based on context, trust, relevance, not just how you're ranking on Google. I think there is, and it's probably quite a bold statement. I think more and more now, less people probably care about you actually ranking number one on Google because you're getting the answer. So because we're getting things so quickly, and because people know that I can go onto ChatGPT or I can ask Google and I'm getting an answer, I think as consumers, I don't think it's necessarily that we're becoming lazy, but we're just getting the answer a lot more quicker. So I think that whole change of great, we're ranking number one on Google. I think, yes, it still matters in some cases, but it's mattering less and less. So I think the question becomes, are you someone that AI would vouch for, or just are you someone that AI is going to vouch for? Are you just a business that's appearing number one on Google? And I think they're two very different things. And I think they've previously mattered very differently. Again, I've been in countless meetings where it's all about rankings and traffic, but I think now it's completely shifted the game and it's turned it on its head. So I think that's probably what I mean by that statement is the game's changed. And if you're not thinking about how you can start appearing on AI, the blunt truth is you're not even in the race. That's the reality.
Right, harsh reality there. Thank you. I have one more question for you, but given that it looks as if we're going to claw back a little bit of time this morning, I just wanted to take a couple of seconds just to plug a couple of forthcoming CPD events that we've got coming up. So 20th of February, we've got an employment law update. And as probably most people know, there's a lot of changes coming up in light of the phase rollout of the new Employment Rights Act 2025. So that's an essential one to attend. 6th of March, we've got tax issues associated with business structures. And on the 20th of March, we've got employment and payroll taxes. Right, Callum, the last one for you then in that case. And I think I wonder if the team in the background might be able to just pop up everybody's contact details so that anybody that needs those for our guest speakers can grab those whilst we're just finishing it up. So Callum, last one from me then. So what is the biggest misconception people still have about SEO in an AI world?
I think the biggest misconception is that SEO alone is enough. And as I said, I think it still matters. But when we're in this AI world, who you are is as important as how your site performs. So your brand, your reviews, your expertise, the way that others talk about your business online, that's what AI is looking for. I think there's still this misconception that, well, it's fine because I'm ranking #1 on Google, and I've already kind of gone into those points. But I think for many businesses, I think many businesses are optimizing for Google without realizing AI tools are building trust, and they're almost building this profile of your business behind the scenes. And you can't fake that. You have to earn it. I think that's the difference here is with SEO, it's very much been a technical game in terms of keywords, backlinks, all the kind of technical jargon without going into it. But there's a technical race going on there. Whereas with AI, it's an authentic race that's going on. You know, again, you're asking businesses to leave you a review, and we're playing much more into that authenticity. So I think the biggest misconception to answer the question is that people think SEO alone is enough.
Right, and on that mic drop moment, I think we are done with our questions. Just to reiterate what I said at the beginning of the session, we are going to package up, Callum, your slides and the materials from Luna and Pareto. We'll get those out via email later on today to everybody that's joined us this morning. So I guess that's all that's left to say from me on behalf of our speakers today. Thank you very much for joining. I hope that you've got sufficient value out of everything that we talked about today. Everybody's contact details are on the screen for those that need them. We'll be back in a couple of weeks. And thank you very much to everybody for joining, and have a great weekend when it arrives.
Thank you.
Thanks,
Thank you.
guys.
Bye.